Good afternoon or good morning, everyone. I was getting my times mixed up a little bit. Hope you're all having a good day. For some reason, my camera is not working. So, at least for the first part of the class, I'm sorry, I'm not going to be able to have a camera. Having difficulties with that. But either way, you've completed your first quiz today. So, I'm not sure if the responses, I'm sorry, if your scores appeared yet, but they will be appearing by tomorrow 10:30 if they haven't appeared yet. Just I want to make sure everybody had a chance to take it and that my other classes also. No, they haven't. Okay, so they'll be on up tomorrow morning by 10:30. Okay, if you want to check. Remember, whatever you got on the quiz is basically what your score is going. That score will be added to the first midterm that we're going to have. Okay, and I just wrote a little note at the bottom of the slide that our first midterm is going to be on October 13th. Okay, and it's going to cover chapters 12, 7, 10, and 9. Okay, and chapter 9 is the intangible assets. That's what we are going to be going over today in this session. Okay, so that's how I plan to move forward. Also, our Apple investment, will the scores be available? Yes, they will be available on McGraw-Hill. That's where they'll show up. Yes. Um, so our Apple investment, again, it's been a little sketchy since we last met. The stock market has taken a bit of a nosedive, but as of a few moments ago, when we met last time, which was last Tuesday, our stock was selling, our Phantom stock was selling at about $112 per share. As of a few moments ago, it was selling at $116.87. Okay, so we've seen it rise a little bit. Again, Trump basically assigned some funds so that the government will not shut down. But unfortunately, what's going on in the airline industry, is that it's anticipated that about 28,000 people could be laid off from the airlines. Okay, and that may happen today. So again, we're still seeing these huge ramifications across the United States. Guys, stay on top of it. Yeah, that's right. Disney as well, Stellon, they ended up laying off a lot of their personnel as well. Disney was a little different because a lot of their personnel was part-time, but it doesn't matter. That was the income those individuals had. So again, we're going to still see huge impacts on the market, on the economy. So again, the best that you could do is, learn from these experiences and try to be prospective. How can this change? How can you use this information to change what you may do, what your career takes you to in the future? And Denisa, the scores are going to be, the grades are going to be posted after 10:30 tomorrow morning. Okay, just so that everybody has a chance to take the exam. All right, so we're going to move on today. I think that's all the catching up we have to do. So today we are going to start a new topic, and this new topic is called intangible assets. Okay, so first of all, what are intangible assets? All right, so basically, intangible assets appear below on the balance sheet. They appear below plant, property, and equipment. Okay, so on the balance sheet, they're listed below plant, property, and equipment. Below PP and E. Okay, again, they're not a tangible asset. You can't go and say, okay, here is my patent, here is my copyright. But typically, what an intangible asset does do is it gives the corporation some type of legally protected right. Okay. Again, intangible assets have no physical substance, but they are used in the operation of the business. Okay. And we're going to go over all the examples of what intangible assets may be for a corporation. Okay. But a good trick question, okay, about intangible assets are accounts receivable? All right. Are accounts receivable considered an intangible asset? What would your answer be to that? No, excellent. Good. Didn't fall for it. Excellent. They are not an intangible asset. All right, and that's because why? Yes, they have no physical presence. They are an asset of the business, but they're not used in the operations. Okay, so that's why accounts receivable would not be considered an intangible asset. Okay, now typically they're used in the operation of the business to generate income. And what we're going to be talking about for this class is that typically what the original value is that is assigned to the intangible asset on the balance sheet, typically it's going to be valued at its cost. Okay, and that's what we've been seeing in the past. Always that was the cost basis for accounting, but we'll see that over time we have to adjust the basis for that asset because no asset except for land lasts forever. Okay, now what are some of the typical intangible assets that we're going to talk about? Things such as patents, copyrights, trademarks, goodwill. Okay, and we're going to be going over them all individually because they all bring different types. But again, remember, it's not tangible, but it is some type of legally protective right that they give to the organization that owns it. Okay, so now what happens in order for an intangible asset to qualify? It must bring, again, just like any other asset, there has to be evidence of future benefits, right? If there's no evidence of future benefits, the cost of this intangible would just be charged to expense in the time period that it's incurred. Okay, but here, since it is bringing future benefits, that's why the asset is going to be capitalized. Okay, and again, since it is intangible, there is certain gray areas as to how much. Okay, so we start with the cost basis for valuation. What basis are we going to carry that asset at over its useful life? Okay, now we remember, all right, you're going to learn a new term here. We remember that when you were baby accountants and you were first learning about fixed assets, you know that when you had long-term fixed assets, how did you basically reduce the value of that asset, okay, over its useful life? What you did is excellent, Rachel, you depreciated it. Very good. All right, so that was the term that you learned last semester. Very good. All right, now remember in chapter 10, okay, when we were talking about bonds, premiums and discounts on bonds payable, okay, we know that those had to be written off over time as well, okay, over the time until that particular bond matured. All right, so premiums and discounts on bonds. Okay, how do we reduce those premiums or discounts over their useful life? Excellent. And Christian, excellent. We amortize them. Okay, same thing really as depreciation, right? You're taking the value of an asset or of an account and basically writing it off over its useful life. Okay, same theory behind that. Okay, what the new term that we're going to learn for this chapter is that when we have intangible assets, we are also, okay, going to amortize the intangible asset over its useful life as well. Okay, but when we later on in the chapter, when we start dealing with when we start dealing with natural resources, we're going to learn another term for natural resources, how when they are written off as well. Okay, so just keep in mind depreciation, amortization, and what we're going to talk about in a little while for natural assets, something called depletion. Okay, they all do this, they all have the same function. Okay, and that's basically writing off an asset over its useful life. Okay, but you have to remember which terms specifically relate to each type of asset that we're going to be talking about. Okay. All right. All right. So here now to discuss it a little more. When we're talking about amortization of an intangible asset, okay. So amortization basically relates to the writing off to expense of the cost of an intangible asset over its useful life. Okay, and that valuation can be tricky. Okay, because how do you know if you're still getting benefits from a copyright? How do you know if you're still getting benefits from a patent? Okay, and again, you always have to look at the market. You have to look at some of the competition, whether they have a new and better product. You have to look at your level of sales to see if you're still getting that same level of sales from the protected intangible asset that you have. All right, but over its useful life, because no asset except land lasts forever, we're going to have to figure out a way to amortize the cost of that asset. Okay, so again, intangible asset, it's not depreciated, but it is amortized, but it's a very similar concept to depreciation. All right, so now the difference. When you're depreciating an intangible asset, okay, when you're depreciating an intangible asset, the journal entry is always going to be a debit to amortization expense. Amortization expense. And then you're always going to list whatever intangible you're relating to. So here would be intangible asset, would be the patent, okay, because you always want to know the detail behind it. Okay, but the difference here is, remember when we were dealing with depreciation, we always had that accumulated depreciation account. Here, when we're dealing with intangible assets, the credit is always going to be directly to the intangible asset account. There is no accumulated depreciation. Okay, so just to keep accountants on their toes, these type of assets are going to be dealt with a little bit differently than if it were a fixed asset. Okay, again, so here the amortization expense, you know that part of the journal entry is then going to go to the income statement as an expense. And then here, the intangible asset, you're just going to reduce the balance of that asset account on the balance sheet. Okay. All right, so again, this is the usual accounting entry, debit to amortization expense, credit to the intangible asset account. And again, it's difficult to basically try to really see what the estimated life is of a trademark. But basically, what you're going to be looking at is that you're going to look at a corporation to determine when are the assets amortized. Okay, good question. Question, Christian. It would be just like the fixed assets, typically at the end of the year, at the end of each year. Okay, and then again, how do you determine how much should be amortized? You're welcome. You would have to look at, look at the intangible asset, and you're going to have to determine, okay, is this intangible asset still bringing a benefit to the corporation? Okay, because you may say, okay, we have a patent. We'll learn that certain assets have a legal life, like a patent has a legal life of 20 years. Okay, but again, that's the maximum legal life. Okay, what happens a lot is that, okay, while the legal life may be 20 years, the corporation that basically purchases the patent knows that it's really only going to have a value for the next 10 years. Why? Because they know that their competition is coming up with a new product that is going to be, that's going to affect the sales of our particular product. Okay, so you always have to test the market and really see, is this intangible asset still bringing a benefit to the corporation? Okay, once a corporation determines they're not getting a benefit from this asset, okay, this intangible asset, what would they have to do? They would have to just remove it from its books and records. Okay, and for our purposes, just to keep it easy, whenever you're amortizing an intangible asset, you're going to use the straight line method. Okay, remember when we talked about depreciation in Accounting 101, there were also like accelerated depreciation methods. They do not exist for intangible assets. It's always going to be the straight line method. And that's basically divided by the useful years of life. Okay. Okay, so the first intangible asset that we're going to be dealing with is goodwill. And goodwill is the trickiest intangible asset. The rules I just told you about assessing the value of it are going to be different. It's not necessarily the cost basis. The way the asset's value is, it's not amortized. It's basically an annual check has to be done. So just to remember, when we're discussing goodwill, okay, goodwill is the exception to the intangible assets rule. We'll start with the exception. This is the toughest one. All right. All right. So what is goodwill? All right. And again, I know a lot of you probably have some preconceived notions as what to goodwill is. Okay. But the first thing that I want you to know about goodwill, it basically, goodwill can only be recorded when one company acquires another company. Okay. Goodwill is only recorded when one corporation purchases another corporation, and that is purchases a majority of the outstanding shares. Okay, so again, goodwill is only recorded when one corporation buys another corporation. Another thing that you have to remember that is goodwill cannot be internally generated. Okay, so let's think about that. Okay, I'm always talking about Apple. Let's think about Apple. All right. Now we know Apple has a high level of sales. Okay. We know that Apple basically is beating out its competitors. Okay, because of the quality of the products, because of their marketing efforts, etc. Okay. So it would be easy to say, you know what? Based on our old definitions in our mind, Apple Corporation does have goodwill. Okay. But unless Apple Corporation has bought out another corporation, you would never see the goodwill account appearing on its balance sheet. Okay. Now remember, goodwill is an intangible asset. Okay. And by definition, what it basically means is that a corporation has paid an excess amount. Okay. Uh, uh, to acquire certain intangible attributes as the result of the acquisition of another company. Okay, so here let's just take an example. Let's say Apple is buying out Foot Locker, just to use an example. Okay, now Apple is going to buy out Foot Locker, and they're going to pay a premium for Foot Locker. Okay, they're going to pay, and that means they're going to pay above the fair market value of the net assets. Okay, now why would Apple be willing to pay above the fair market value of the net assets for Foot Locker? All right. Basically, that's because maybe Foot Locker has a positive reputation. Okay. They have quality products. They have a favorable reputation in the sporting goods industry. Okay. So they know, you know what? We're going to pay a premium in order for to own that company. Okay. Foot Locker maybe has a positive market share. Okay. They're the leader in that market, maybe for athletic goods. So therefore, Apple executives determined, okay, we're willing to basically pay a premium to buy out that company. Okay, Foot Locker may have a positive marketing image. Okay, Foot Locker has developed this image over time of quality products, quality employees, good customer service, etc. So again, Apple's willing to pay a premium for those shares. Okay, again, or Foot Locker may have a reputation for high quality and loyal employees. Okay, and think of how intangible that is. Okay, there's not really a price that you can put on, okay, quality employees who are loyal. But again, you would see the benefits of that. You would see the effects of that type of attribute through higher level sales that Foot Locker has. Okay, they may have a superior management team. okay? Or they may have some type of manufacturing or operating advantages. Okay, they have their own manufacturing sites, they have some economies of scale, etc. Okay, so again, Apple is buying out Foot Locker, all right, and by definition, okay, how do we figure out what the amount of goodwill is? All right, what is the definition of how goodwill is calculated? Okay, and that is going to be it is calculated by the excess paid for the excess paid for I'm sorry, so the excess paid above fair market value, the excess paid above the fair market value, the fair market value of the net assets. Okay, and we're going to work on that definition a little bit. Okay, so how goodwill is calculated, it's always going to be the excess paid over the fair market value of the net assets. All right, so it gets a little bit complicated, okay, but we're going to see in a little while how this is always, what the equation is and how we're always, basically, you're going to be provided this information, all right, and then you're going to do the calculation. I know, unfortunately, Rachel, on Blackboard, I can't fit the entire slide. But if you look on on Blackboard under materials, you should be able to see it. Okay, and again here, the last thing that we see here is why would Apple be willing to pay more for Foot Locker? Because they have some manufacturing or other operating efficiencies. Okay. All right. No, I was typing something just here. The definition of how you calculate it. Okay. All right. Now remember, goodwill is the toughest intangible asset to value. All right. So we're going to learn this one first, but it is the trickiest one. Oops. Okay. All right. So here, let me go to a blank screen, and then we're going to go over this. All right. So here we're only discussing the intangible asset of goodwill. All right. Now, how is goodwill calculated? Okay. So how goodwill is calculated? It's going to equal the excess paid. Oops, is always going to equal the excess paid for the net, and that's the key here, the net fair market value, of the assets. Okay, so again, what happens is that a corporation, let's say Apple is going to acquire Foot Locker. Okay, now we know that let's say the net assets, okay, based on the book value. Okay, and we know the book value is basically what is the cost basis. When we look at the net assets, what the book value of those assets are, okay, let's say that, and again, that's going to be the net assets minus the net liabilities, right? Net assets equals the assets minus the liabilities. So the net assets, the book value, is going to be $1 million. Let's just take an example. Let's say that equals $1 million. Okay. All right. But if we look at what the value of the net assets is, okay, based on the fair market value, Okay, if we look at the excess of the net assets using the fair market value as opposed to the book value, the excess of the net assets, oops, using the fair market value. Hold on there. Using the fair market value, if we determine that that value is actually $2 million, okay, what is going to be the basis for our calculation or for the value of goodwill? Are we going to use the $1 million basis, or are we going to use the $2 million basis for determining the amount of goodwill? Okay, remember the starting point is always going to be, let me just see who's answering here. It's always going to be the fair market value of the net assets. Okay, so we're not going to use the book value. Rachel and Lysander, very good. We are going to use we're not going to use the book value. It's always using the fair market value. Okay, and how do we determine the fair market value? It's going to basically be, the equation will be fair market value, the fair market value, oops, of the net assets of, I'm sorry, fair market value of the assets less the fair market value of the liabilities. Okay, so that's how we're going to determine what the basis for our calculation is. Okay, we're not going to worry about the book value of the assets. Okay, what we're going, and again, you would have to be provided this information. Okay, just know that here, when we're determining what the basis, how much this company should be valued at, okay, we're always going, and this is how much, in our example, how much Foot Locker should be valued at. It's basically, we're going to look at the fair market value of all of the assets of Foot Locker, less the fair market value of all the liabilities of Foot Locker. Okay, all right, so let's use an example. All right, so let's say we are interested in buying a restaurant. Okay, we're interested in buying a restaurant, and you know what, does everybody have this information? Okay, because okay, good. So I'm just going to erase this screen just so that I can use the whole slide. All right, so basically we're interested in buying a restaurant, okay, and we're looking at two restaurants in particular. Okay, so again, before you buy a restaurant, what are you going to do? Again, you're going to be doing a lot of industry analysis. You're going to look at a lot of different locations. You're going to look to basically what the norm is, what the expected earnings are. Okay, that's what you're going to do before you invest in any type of business. Okay, so this is, we're basically looking at, we're a buyer, and we're looking at two different types of restaurants. Okay, one restaurant is called Mandarin Coast. Okay, and the other restaurant is called Golden Dragon. Okay, and now how do we determine how much these different restaurants, how do we determine how much we as a buyer should be paying for these restaurants? So the starting point, again, as I showed in the earlier slide, is the fair market value of the net assets. All right, so again, don't get tricked. In the example, you're always also going to be told what the book value of the net assets are. And again, net assets means it's means assets minus liabilities. Okay, we're not focusing on book value here. That's really meaningless to the buyer. We're going to focus on the fair market value. So here we're given the fair market value of the net assets equals $1 million. Okay. And that's going to be the same for both restaurants. Okay, the fair market value. So we're starting off with a level playing field. Okay, all right, very nice. So what else are we going to do? What's the next step? we're going to look at industry guides, okay, and we're going to determine for that particular area that we're looking in, we're going to figure out what the normal rate of return is, okay, for that type of restaurant in the specific area that we're looking at. Again, because these things are basically, they basically change based on where you're planning on making your investment. So you look at industry guides and you determine, okay, a normal return on on the amount of assets that we're investing on an annual basis would be 15%. All right, and again, that would be the same for both restaurants. Okay, so what does that mean? That means based on the fair market value of the net assets that that the business has contributed, that is how much Mandarin Coast has contributed, they can basically expect their normal earnings to be on an annual basis. They can expect their normal earnings on an annual basis to be what? What do you think, guys? How much? 150,000. Okay. Yeah, forgot the zero. Very good. So it would be about 150,000. Okay, that's pretty straightforward, right? That you can figure out. It makes sense, right? Because when you look at a business, you're always looking to basically determine what your annual returns would be. Okay, to decide whether you're actually going to invest in it. Ah, okay. So what is this? Sorry. Sorry. So this here. This should be, let me just, that should be 150,000 as well. Okay. Yes, that's it. And you always set up, Joshua, when you have a problem like this, you always set it up this way. Okay, and again, this is only for goodwill. All right. All right. So now we know the normal earnings for each of these businesses should be $150,000 based on the assets that were committed to the business. Okay. So what do you think we're going to compare now? We're going to look at the average actual earnings. Okay, we're going to look at the average actual earnings for this restaurant for the past 5 years. And you could, again, it could be past 5 years, past 10 years, whatever period of time you think is relevant. Past 5 years. For past 5 years. And again, you would be given all of this information. There's no way you could figure it out. Okay, so here, we find out that for Mandarin Coast, their average earnings, actual earnings for the last 5 years, the average earnings have been 150,000. And again, where would I get that from? I would look at the financial statements for Mandarin Coast. I would look to see their tax returns, right, to verify that's how much they're actually making. Okay, I'm not just going to take the owner's word of mouth. Okay, so here I see the actual average earnings, 150,000. However, now when I look at what the average earnings are for Golden Dragon, I'm able to verify that their average earnings of annual earnings for the last 5 years equals $200,000. Okay, so here, that's a substantial difference. All right, now what do we do with that information? Okay, when we look at the normal earnings and compare it to the actual earnings, it's going to tell us how much excess earnings each of these different restaurants had. Okay, on average for the last 5 years. So here we could see normal for Mandarin Coast, their normal earnings equals their average earnings, so they don't have any excess earnings. Okay, so if we were to buy Mandarin Coast, what value would we offer to pay for Mandarin Coast? if they just have normal earnings? What do you think as a savvy investor? What would you offer for Mandarin Coast if they don't have any excess earnings? They have whatever the industry standard is of 15%. Okay, you would most likely be willing to pay them what the fair market value of their net assets is, right? Because they don't have any excess earnings. You would just be basically willing to pay for their assets minus their liabilities, the fair market value, which equals $1 million. Okay, now where does this get tricky? It gets tricky with Golden Dragon. Okay, because what does Golden Dragon have? Golden Dragon has excess earnings. Okay, on an annual basis of how much? They have excess earnings of $50,000. Okay, so now what does that mean? How much would you then be willing to pay for, would you be willing to pay for this restaurant because of the fact that they have excess earnings? Okay, so the most popular way, okay, to determine the amount of goodwill, okay, that you're going to be willing to pay is basically value the business as a whole. Okay, and then subtract the value of the net identifiable assets. Okay, so can you explain the calculation again for the normal earnings? Yes. Okay, so here, Joshua, okay, so the first thing we had to figure out, you're going to be in a problem, you would be given all of this information. Okay, you would be given basically the fair market value of Mandarin Coast's assets and the fair market value of any competitor's assets, or its Golden Dragon's assets. And again, we're not looking at the book value. We're always going to be talking about the fair market value. And you would have to be provided this. Okay, and again, here we're talking about net assets. So what does net assets mean? That means basically it's the total assets minus total liabilities. So the difference, okay, of between the fair market value of the assets and liabilities for Mandarin Coast equals $1 million. Okay, same thing for Golden Dragon. All right, the difference between the total assets and the total liabilities equals $1 million. All right, then you would always have to be told, in these problems, you have to be told what the normal rate of return is, and that's always going to be in that particular industry. So in the restaurant industry, it's a standard that basically through industry guides, you're told that the normal rate of return is 15%. Okay, so since Mandarin Dragon, okay, has invested $1 million in their net assets, okay, since the expected rate of return is 15%, what is the normal amount of earnings then, okay, that someone could expect from Mandarin Coast based on their contribution of assets? Okay. Same thing for Golden Dragon. They have the fair market value of their net assets equals $1 million. Their normal rate of return is 15%. So based on their contribution of assets, expectation is for that particular industry, they're going to be getting, it would be normal for them to have earnings of $150,000. Okay, now, and again, that's projected earnings. All right, now what's the next step? You as a potential buyer, you're going to look at what the actual, okay, the average actual earnings per year has been for the past 5 years. Again, you're not just going to look at last year's. It might have been an exceptionally good year. You're always going to look at over several years of the trend. Okay, so looking at that, you see that actually the sales, okay, for Mandarin Coast have been $150,000 per year. The average earnings, I'm sorry, not sales, the average net income has been $150,000, and that's what's expected for this particular industry, a 15% return on the assets. on the underlying assets. Okay, but and again, you would have to be given all this information. You just know how have to set up the problem. Okay, now though, you're also told that the actual sales for Golden Dragon are $200,000 on average for the last 5 years. So what does that mean? That means that Golden Dragon has excess earnings on an annual basis of $50,000. Okay, so what does that translate into? If you were a buyer for either of these restaurants, you would expect to pay a premium, okay, if for Golden Dragon, okay, over Mandarin Coast, if you were interested in buying this business. Why would you expect to pay a premium? Because of the fact that they have excess earnings. Okay, the owner of Golden Dragon is not just going to say, okay, we're going to give you $1 million. They accept that. All right, so in a problem like this, is it typical that the normal earnings is the same between them, or just and typically this, when you look at the actual earnings, that's when you're going to make your judgment call. So what would you expect? Okay, so Joshua, let's bring this home. All right, so now you're looking at what earnings are, you're looking at what the actual earnings are. Which company would you most likely pay more for? Which company would you have to pay more than the fair market value of their net assets for if you were purchasing it? Golden Dragon, exactly. Okay, since our earnings are in excess of the average earnings, if you were purchasing Golden Dragon, okay, the purchaser of Golden Dragon is going to have to pay goodwill. Okay, will pay goodwill. And why is that? That's one of those attributes that a buyer is willing to pay more for. They're willing to pay more because of the fact that they have excess earnings. Okay? And now, but how many, now again, we know they have excess earnings of $50,000. How much goodwill would I be willing to pay as a purchaser? How much goodwill would I be willing to pay? Am I just going to pay $50,000 in excess of the fair market value? Or am I going to have to pay for more than just 1 year of excess earnings? Okay, so the easiest way or the most popular way, all right, so does everybody have this information? Everybody's going to erase this? Okay, all right. So what's the typical way that you're going to value this? What's going to happen is that you're also going to be told in the problem, you're going to be told the rate at which restaurants, and again, this will be for whatever industry we're talking about. Here, it's the rate at which restaurants typically sell for the rate at which restaurants typically sell for based on their earnings. And again, where would you get this type of information from? You would get it from industry guides. You would have to be told this information. Okay, so if you were told that typically restaurants in this industry sell at 6.5 times their annual earnings. Their annual earnings. Okay, how would you figure that out then? What would you do? All right, so now Golden Dragon, what were their annual earnings? Their annual earnings were $200,000, right? If we look at the previous slide, and again, you were provided that information. Golden Dragon had actual earnings of $200,000 per year. All right, so what are you going to multiply it by? You're going to multiply it by the 6.5. Okay, because in that particular industry, Okay, that's basically the ratio that is used to determine what the sales price of of a restaurant should be. So if you take the $2 million, which is the earnings of Golden Dragon, multiply it by that factor of 6.5, you're going to get a total of $1,300,000. Okay, so that's how much a buyer of Golden Dragon would be willing to pay, okay, for that particular restaurant. You're going to look at what the industry trend is. Okay, the industry trend is that typically restaurants in that area sell at 6.5%, 6.5 times their annual earnings, and that's actual earnings. Okay, so that's going to be the sales price. Okay, that's going to be the sales price of Golden Dragon. Okay, but now, okay, what's the tricky part? How much of that sales price is going to be attributable to goodwill? Okay, so how much of that sales price? Okay, because this is really our problem, right? We're trying to figure out, first of all, how much do we offer for that restaurant, and then how much basically is the purchaser going to have to record as goodwill? So how much of the purchase price is going to be considered going goodwill? Any suggestions? 300,000, excellent. And why is that, Gerson? Okay, exactly. Very good. Okay, so what you're going to do is that you know the fair market value of the net assets equals $1 million, right? You're told that from the beginning of the problem. All right, but okay, you're willing to pay. Basically, the purchaser is willing to pay. Oops, the price of the restaurant is basically $1,300,000. So the excess, okay, above the fair market value of the assets, that is going to be the amount that is going to be debited to the goodwill account. Okay, now, question though, whose books and records is that goodwill going to appear? Okay, is it going to appear on the purchaser's books and records or on the seller's books and records? No, on the actually, Joshua, on the seller's books and records, it's going to be a gain, right? Where is the asset of goodwill going to appear? Okay, it's going to be on the purchaser's assets. Very good, still on. It's going to be on the purchaser's books and records. Yes, because here, remember, the fair market value of the assets, okay, is $1 million. All right, but the purchaser was willing to pay $1.3 million. All right, so on the purchaser's books and records, what are they going to be recording? They're going to be recording the building that they purchased as an asset. They're going to be recording whatever the equipment that they purchased, okay, at the fair market value, and they're also going to be reducing the value of those assets by the liabilities. Okay, yes, and it's going to be the difference, and the result is a debit to the goodwill account. Exactly. And then again, since the assets and the liabilities are not going to equal, why is that? Because of the fact that they paid $300,000 in excess. So this $300,000 is going to be debited to goodwill. And where does this goodwill account appear on the purchaser's balance sheet? Joshua, where does this goodwill account appear on the purchaser's balance sheet? A debit, okay, it has a debit balance, but where on the balance sheet? What is goodwill considered? Not income statement. On the balance sheet, where is goodwill going to appear? Under which section? Intangible assets. Very good. Excellent, guys. It's under the intangible assets. And that's how goodwill is valued. Okay? It's basically always going to be, all right? Goodwill is always going to be the excess of the fair market value of the assets. Okay? And this is how we determine what the excess was. Okay? And now here, Lysander, I know you have a question. Yes, Lysander, go ahead.
Oh, so you said that it'll be the result will be a debit to the goodwill account. I thought that the debit was the amortization.
No, we haven't gotten to amortization yet.
Oh,
Here,
so the
all we're talking about is how do we figure out the amount, what is going to be debited to that goodwill account. We haven't gotten to amortization yet, even.
okay. And can you just repeat real quickly the last point you said that goodwill is the excess of
The price paid, okay, the price paid for the business above the fair market value of the net assets.
Okay, thank you.
Okay, you're welcome. All right, so now all we've done here is that we've basically recorded the debit to our goodwill account. Okay, the purchaser now has a $300,000 debit balance in that account. Remember, that's not, and this is why it's only, if you see goodwill appearing on a balance sheet, you know that that corporation had to have bought out another corporation. Okay, that's the only way goodwill is going to appear on your balance sheet in that particular instance. Okay, now though, remember now, so we pay goodwill at this particular point in time. Okay, so what's going to happen? We know that typically if we buy a business, okay, we don't know how long that goodwill is actually going to be an asset. Okay, because what typically happens is that over time, that goodwill account is basically going to be used up. It's not going to be existent anymore. Okay, so remember I told you for all other intangible assets, okay, all other intangible assets are amortized. Okay, and at the end of the year, we should basically do an estimate, and we look to see, we're going to basically write it off to expense over its useful life. Okay, that is not what happens though with goodwill. Since goodwill is such a tricky asset to value, okay, what has to happen if you have goodwill is that goodwill, and this is just basically the rule, goodwill must be tested at the end of every year. So the amount of goodwill, okay, at the end of the year, okay, what's going to have to happen on the purchaser's book records? They're going to test goodwill to see if the value of the goodwill is still equal to $300,000. Okay, if the value of the goodwill has decreased, okay, what's basically going to happen in that particular, it's going to be charged to impairment, to the impairment of goodwill expense account. Oops, impairment of goodwill expense. Okay, so goodwill is different from any other intangible asset. Okay, it cannot simply be amortized over its useful life. What's going to happen is that goodwill must be tested at the end of every year to see if the value of that goodwill is still what its cost was. As in this instance, it's going to be $300,000. Okay, realize though is that goodwill is never increased in value, is never increased. So if the level of sales is greater than the $50,000 that it was previously, goodwill is never increased for excess sales. Okay, it is only decreased, okay, if the level of sales has basically fallen. So impairment of goodwill expense, no, because remember, what happens whenever you see that word expense, what's the first thing that you're going to remember? What do you do? It's a debit, yes. So what is the journal entry? Okay, so let's say, and again, you would be given this information. So let's say the new owners of Gold Coast, okay, or the new owners of Gold Coast determined that at the end of the year, a Golden Dragon, they basically determined that goodwill has actually been impaired by $20,000. Okay, and typically, what does that mean? The level of sales that they were anticipating for this year, or the amount of their net profit for this year, is lower than they anticipated. Okay, so that means that some of that goodwill that they purchased is no longer valid. Okay, so what would that journal entry be? You would debit the impairment of goodwill but you would debit that expense account. Okay, for the $20,000 or whatever they felt the goodwill is impaired by. Okay, and then you would just credit. Anybody want to offer a suggestion? What would you credit? I debit the impairment of goodwill, and then what would I credit at year end when I'm reassessing my value? What do we do when we have intangible assets and we're amortizing an intangible asset? Good, exactly. As I said, we're going to credit the goodwill account directly. Okay, so remember, okay, goodwill is the trickiest intangible asset account. Okay, the only time that goodwill appears on the balance sheet is when a corporation has bought out, when one corporation has bought out another corporation or bought out the assets of another corporation, and they've paid above the net fair market value. Okay. In the previous instance, we saw that this corporation, that Golden Dragon, had $50,000 in excess earnings. Their actual earnings was $200,000 per year. And again, we would get that from their income statement. So their average earnings was $200,000 per year. Okay, we were told that in that industry, typically restaurants sell for 6.5 times their annual earnings. So we took the $200,000 and multiplied it by the 6.5, okay, by that factor that we're given for that industry. So that means the sales price should be $1,300,000. Okay. Now, all right, if the seller was willing to pay the 1,300,000, what has to happen at the end of every year? The amount of goodwill must be tested. The remaining goodwill must be tested at the end of every year. So here, if you're told that the purchaser of Golden Dragon determined that the goodwill account has actually been impaired by $20,000, okay, what would that journal entry be? Okay, they would debit the impairment of goodwill expense account, and that would be a normal expense account that appears on the income statement, and they would credit their asset account goodwill. Okay, now again, is there ever any instance where if they see the level of their sales have actually increased? Is there ever an instance where the owners of Golden Dragon can increase their goodwill account, okay, based on X earnings? Okay, so could the owners of Golden Dragon increase their goodwill account because they have excess earnings? It wasn't impaired, it actually was above. No, not never. Okay, in that instance, you can never increase the goodwill account. Okay, you can only basically write it off over if you see an impairment. So the value of the goodwill account will never be greater than $300,000 unless you buy another business. Okay, but for Golden Dragon, the goodwill account is never going to be greater than what the excess cost was, which was $300,000 in this instance. Okay, all right. All right. And then let me see. All right. So goodwill is never, all right. So is goodwill amortized? If I asked you on an exam, is goodwill amortized? What would your answer be? No. Very good, Josh. Shall I say no? Excellent. No. Goodwill is always going to be tested. Very good, Shamia. Goodwill is always tested at year end to see if its value still exists. Okay. Now, another question. Here, remember I said here that the earnings of Golden Dragon was $200,000. The actual earnings of Golden Dragon was $200,000 in each of the last 5 years on average. Okay, times the 6.5 times that industry factor that you're going to be provided. So that means that basically the cost basis would be 1,000,003. But what if I'm the purchaser? What if I say, you know what? I don't want to pay 1 million. Remember, this 1,000,003 is only the basis for negotiations. What happens? Okay, so now, okay, good potential questions. What happens if I tell you that the buyer of the purchaser for Golden Dragon actually only offers $1,200,000? Okay, for Golden Dragon. Okay, they said, okay, I see your calculation, but we don't want to pay 1,300,000. Okay, we are willing to pay 1,200,000 for Golden Dragon. Okay, take it or leave it. Okay, if they only pay, okay, that becomes the actual sales price or actual purchase price. If we're looking at from the buyer's perspective, um, okay, if it's 1,200,000, and that's accepted by the current owners, what would the amount of goodwill then be? Okay, if basically if Golden Dragon is sold for 1,200,000. Okay, excellent, Shamia, $200,000 exactly. Okay, because that means again that $1,300,000 again that is not written in stone. That is just a basis for to start negotiations. So in the instance that they arrive at a price of 1,200,000, okay, in that particular instance, the amount of goodwill would only be $200,000. Okay. All right. So that is basically everything about goodwill that you can imagine, everything that you need to know. Okay. Set up your work paper like I did earlier, comparing the two different businesses. Okay. And then you look at the normal rate of return. You compare the normal rate of return on those assets to what the actual net income is. Okay. The only time goodwill is going to be paid is when there's actual excess earnings. Okay, if you have average earnings in your business, a buyer is not going to be willing to pay more. Okay, than that amount. And again, what has to happen to goodwill at the end of each year? Goodwill must be tested, okay, to determine if its value still exists. Okay, if the value of the goodwill has decreased, an impairment of goodwill journal entry must appear. Okay, so after this journal entry, last question. After this journal entry, all right, at year end, what is the balance? Okay, so going back to the original example where the purchaser purchased Golden Dragon for 1,000,003. After this journal entry, at the end of the year, what is the balance in the goodwill account? After this year-end adjustment. No, don't get confused. What do? We take the $300,000, right? Because the goodwill account, again, has a balance of $300,000, not zero. How much do we reduce the goodwill account by? We reduced goodwill by 20,000. So yes, it would be 2 million, I'm sorry, $280,000. Very good, Casey. We're reducing it, very good, by $20,000. Remember though, we're reducing goodwill. Go back to the amount that we established in the goodwill account, which was here, $300,000. If I'm only reducing it by 20,000, what's the remaining balance? 280,000. Is that clear? Okay. All right, guys, so I am going to continue then. We went over goodwill. I'm going to continue with, I believe, patents is the next intangible assets that we're going to go over. Okay, and again, the other intangible assets are all a little bit easier. Okay, goodwill was the tricky one. Goodwill was really the exception. Okay, you'll find out what your scores on your quiz were tomorrow morning. And just keep in mind, we're going to have the midterm, and the midterm exam is going to be on Blackboard. Okay, so just make a little note of that. And yes, the test is going to cover chapters 12, 10, 7, and 9. Again, just those particular sections that we covered. Okay, because some of them were partials. And if we have questions about the quiz, can we ask them? Absolutely. Absolutely. We can even go over the quizzes next class. But I think the way I set it up also, Rachel, is that when you get your test, your quiz score, you're going to see all the detail behind it as well. But you can always email me or text me, for any questions. Okay. Okay, you're welcome. Have a good day, Manpreet. You too. Have a good weekend. Stay healthy, stay happy, and register to vote. Don't forget, register to vote, everybody. Very important. You're welcome, guys. Have a good weekend. Thank you, Lamia. You too. Professor, for the quiz, it auto submits my answers, right, Iran? I hope so. Yes, Jason. We'll look at. I'll check that. It should have. Yes, it should have. Either way, I would give you credit for that. Don't worry.